Welcome to the Big Picture Retirement Show, where you'll learn what it really takes to have a successful retirement. With over 20 years of experience, your host, Rick Rivera of Safeguard Investment Advisory Group, has seen it all and is here to help you achieve your retirement dreams. This is the Big Picture Retirement Show.
Welcome into the Big Picture Retirement Show with Rick Rivera. I'm Mark Elliott. Rick, of course, is a partner at Safeguard Investment Advisory Group, has over 20 years of experience in the financial industry. But the team at Safeguard Investment Advisory Group really is here to help you figure out where you are on that road to retirement. Can I retire? Do I have enough? Are we going to be okay? I'd really like to find, I think I've got enough, but I don't know. Why wouldn't you get some clarity? Rick and the team are certainly here to help guide you. There's no cost for this because it's got to be a good fit for Rick. It's got to be a good fit for you if you'd actually become partners in this retirement. But maybe not. Maybe you're just going to come get some great insight into your retirement picture, and then you just keep doing what you're doing because Rick says, hey, you're doing a great job. Keep doing it. That'd be nice to know, wouldn't it? 800-700-1980 is the number. 800-700-1980. No cost to you. You can always check out the website to learn more, safeguardinvestment.com, safeguardinvestment.com. Rick, I think there's no doubt a lot of people find retirement planning kind of overwhelming. I mean, when you sit down with people and walk them through the big picture blueprint, it's about income, it's about investments, it's about taxes, it's about healthcare, it's about legacy planning, it's about Social Security decisions, Medicare decisions. There's so many things going on in our portfolio, for one, because certainly when you get to the end of the year, it's Roth conversions got to be done by December 31st. Our required minimum distributions, if you're that age, they've got to be done by December 31st. There are things you have to have done, but we always hear this word rebalance. Well, you really should rebalance your portfolio. I'm not a financial whiz like you, Rick. I'm 65. I'm supposed to know all of this, but I guess explain to me, what is rebalancing? Why is it important?
Actually, that's a great question, Mark. And actually, I'm glad you asked it because people may hear the term and they're not quite sure exactly what that means. And we should probably put some, definition or context to it. So I'm glad you're asking the question. When it comes to rebalancing a portfolio, I'll give you maybe some simple examples and we can, expand out from what I'm going to discuss right now. But let's say, you sit down with a client and, based on their particular parameters and based upon their particular risk tolerance, you come up with a portfolio. And again, I'll just use a simple example. Let's say a 60-40 portfolio where you have 60% of the money that's in equity, stock type of positions. And then you have 40% that's in, let's just say, fixed income bonds, things of that nature. Well, the reason why you're splitting up the portfolio this way or diversifying in such a way, again, is based on a client's particular risk tolerance or whatever objectives are designed for that particular portfolio. Where the rebalancing comes in is that in some cases, as the market moves up and down every day, that rebalancing can get a little out of whack. So let's just say, for example, the market shoots up, and now the equity portion of the portfolio is now 70% of it because, equities, the stocks have moved up in price. And now the value of the bonds, or we'll call it the more safe component of the portfolio, is now 30%. So you got a 70-30 split. Well, with that being said, there's two folds. Now the level of risk that we're willing to take in the portfolio has increased because now we have a higher equity valued position. So we may want to sell some of those positions and move it over into the safe area, again, to rebalance the portfolio down to 60-40. The other advantage of rebalancing, the portfolio in that fashion is that, remember, a gain is not a gain until it's realized. So not only does rebalancing the portfolio allow us to make sure that the portfolio is staying within the client's, we'll call it risk tolerance, but it also allows us to take advantage of gains when the market is up. Because again, a gain is not a gain until it's realized. The reverse can happen as well, Mark. Let's say, for example, the market is down. And now the equity position went from being 60-40 to now it's 50-50.
So could that have happened like 2000 to 2009? We had dot-com bubble bursting. We had 9/11. Then we had the Great Recession, 07 to 09. Would that be something that was like the reverse of the rebalancing because it went the wrong way?
Yeah. So let's say, in a scenario where the market goes the other way, well, now what's going to happen is, here's the thing. Now we have the equities are valued at a lower price and the fixed income is at a higher price. So now what we may want to do is we may want to sell some of the fixed income and buy more shares at the cheaper prices. So again, as long as we're buying good fundamental positions and we know that the market is going to move on a regular basis from time to time, when the market is down, well, great. That'll allow us to sell some of the fixed income and buy more shares at cheaper prices. The interest and dividends are being reinvested, buying you more shares at cheaper prices. That way, when the market rebounds again, you have more shares in your bucket and you'll rebound a little bit more quickly because you have more shares in your bucket. So you're actually using rebalancing to your favor. Again, provided that we're buying good fundamental positions. I'm not talking about speculative stuff, but that's a simple example of where we would use it. And I can go into just real quick, Mark, something else that's a very important part of rebalancing too. If I can kind of delve under the hood here a little bit, is what we do for our clients too. Is that, let's say, for example, they have a variety of exchange traded funds or mutual funds or whatever it is within the portfolio. Another reason why we would rebalance or even take out certain positions is, as a firm, for our clients, we actually look internally what these exchange traded funds or mutual funds are actually buying. And if we find out that, hey, internally, some of these funds are, let's just say, are buying utilities, and we have a utility position in the portfolio, we might say, hey, you know what? Now that they're kind of upping their percentages in utilities, we don't need to have a separate utility position in the portfolio, because then now we become overweighted in one area. So we actually look at what they're internally buying to make sure that, hey, are we becoming over correlated in one area? So do we need to readjust the portfolio based on that? Or maybe the opposite. Maybe we're being negatively correlated, where, based upon what one fund is buying and what another fund is buying, maybe they're working opposite of each other. And now we have to rebalance or change those positions for the client as well.
That makes sense. And so if you've never really thought about rebalancing, you put your money in the 401k and kind of let it ride, which is what a lot of people do. It's an opportunity just to find out where you are. Are you really at the risk profile in your portfolio that you think you are? If we have another 2008, are you going to lose 10%? Or are you going to lose 50%? That's kind of the idea behind rebalancing. Rick and the team at Safeguard Investment Advisory Group here to help. Again, it's 800-700-1980. Totally complimentary, no cost to you. It's a great opportunity for you, I think, to find out more about your situation. 800-700-1980. Rick, I guess, how often should we think of rebalancing? Is it every quarter? Is it once a year? Does it depend on what the markets have been doing? How do you look at how often should we think about rebalancing?
So let me just tell you what we do for our clients. What we do for our clients is every quarter we rebalance the portfolio. But let me put that into context. Depending upon what is going on in the economy, we may have to rebalance it prior to the quarter coming up. Now, also depending upon what's going on in the economy, just because the quarter hit doesn't necessarily mean we need to rebalance it automatically just for the sake of rebalancing. So we are looking at it on a regular basis and adjusting as needed. So we automatically look at it every quarter. However, there may be things that occur prior to the quarter that require us to do it more frequently than that. Other times, the quarter comes by and we're like, hey, listen, based upon what's going on in the economy, the portfolio is still within the same frame structure that we like it. We don't need to rebalance, but it's something that we should look at on a regular basis. Now, here is another scenario where we may need to rebalance outside of just, let's just say, market conditions and what have you, is a client's particular situation may change. Where, let's say, based on the plan that we have, a client had a certain risk tolerance, and maybe they told us, hey, Rick, you know what, we're going to be retiring in 3 years, and we know we need to create income. So we set up the portfolio based on them retiring in 3 years. But then all of a sudden, maybe circumstances change, and they call me up a year later and they say, hey, Rick, I told you I was going to retire by this date, but, I have this new opportunity, and actually, I don't plan on retiring for another 6 or 7 years, whatever the case may be. So then we can say, okay, well, now with this new information, or now based upon these new goals or objectives, let's now talk about readjusting the portfolio or rebalancing the portfolio based on this new scenario that has just developed. So not only market conditions may require the rebalancing of the portfolio, but obviously your own personal circumstances, whether it be to new job or decide the opposite. Maybe you were thinking about retiring, you told us, hey, you're going to retire, 10 years from now. And all of a sudden, you're like, Rick, you know what? I had enough. You know what? The most I can put in is another 2 or 3 years. So let's just revamp everything up again. And let's base it upon me retiring on a shorter period of time. So a lot can happen, but that would be some quick reasons off the top of my head where we would want to make sure that we're rebalancing the portfolio.
Okay, let me give you another scenario. This one's a weird one, I think. 401ks typically are in mutual funds, right?
Mm-hmm.
Are mutual fund rebalancing like doing a rebalancing of the stocks and bonds and stuff that we own? I mean, mutual funds are different, but a lot of people 401ks made up of mutual funds.
Yeah, and this is what I was saying earlier, that it's important for us to understand, because in the mutual funds, there is a manager that's actively managing the different positions within that fund, and they're changing it around, on a regular basis. So it's important for you to understand that, let's say you have a growth fund, and let's say you have a value fund, and you have some other fund, dividend fund, whatever it is. You have a variety of different mutual funds within the portfolio. Most people, they think, oh, okay, well, I have several different funds, 3 different names, I'm diversified. It's very important that we look internally, what are these funds actually purchasing? Because you could have a scenario where, let's say you have 3 different funds, and one fund is buying Exxon because they think it's a great dividend play. Another fund is buying Exxon because they think it's a great value play. And then another fund is buying Exxon because they think it's a growth play. Now you're overly invested in one particular stock, or maybe maybe they're not buying the same stock, but they're buying the same industry. And now you're overly invested or over correlated in one industry. Or they could be buying opposites. So what we do for our clients specifically is that when we are putting these portfolios together, especially if they have 401ks, we'll tell them, hey, listen, give us your picks. Let us know what your options are available within that 401k. And let's say your firm, like for example, we have a lot of Kaiser employees. And Kaiser, they pick Vanguard funds. And they have about 18 Vanguard funds or so that they can choose from. So when we're picking funds for them, we'll make sure that we look internally what these funds are buying. And then from time to time, we can let the clients know if they need to make some adjustments to the funds that they have within their 401k. So it is important to look internally as to what they're buying.
Okay, I like that. Now we understand rebalancing a little bit better. And if you have questions about this, maybe you've not rebalanced. Maybe you've just kind of been one of those, you go to work, you've set it and forgot it. Now you're getting closer to retirement. You're going, I wonder how my risk is really matching up with what I think it is. Talk with the team at Safeguard Investment Advisory Group, 800-700-1980. There's no cost to you. 800-700-1980 could be one of the most important free phone calls you ever make. 800-700-1980. Back with more with Rick Rivera right here on the Big Picture Retirement Show. We're back right after this.
You're listening to the Big Picture Retirement Show with Rick Rivera. For more information about Rick and the Safeguard Investment Advisory Group team, go to safeguardinvestment.com. While you're there, you can also download educational retirement guides and sign up for an upcoming seminar. That's safeguardinvestment.com. Now, back to the podcast.
Welcome back to the Big Picture Retirement Show with Rick Rivera. Rick is a partner at Safeguard Investment Advisory Group. You can always go to the website to learn more, safeguardinvestment.com. I'm Mark Elliott. If you have questions, we were talking about rebalancing. What's the importance of rebalancing? How often should we do rebalance our portfolio? Because it could get too overly maybe in one direction or the other because of what's been going on in the market. All you have to do is call the team. Rick and the team are here to help. 800-700-1980. 800-700-1980. Now, we know the 2017 Tax Cuts and Jobs Act is set to expire at the end of 2025. And on paper right now, in 2026, we're supposed to go back to the 17 rates and brackets, which means you get to the higher tax. The 12 becomes 15, the 22 becomes 25, the 24 becomes 28. And you're like, well, that's just like a 3% tax increase. Well, it's actually about a 20 to 30% tax increase, depending on which bracket you're affected by. So taxes are a big deal, and Trump has said he will try to continue that if he can, but we know that's got to go through Congress. So he can say it. We'll see how it works. But how big are taxes? When you think of rebalancing, I think of rebalancing stocks and bonds. But tax-wise, I mean, there's things we do at the end of the year like tax harvesting. Hey, we lost in this, but we won in that. Let's offset them. I mean, taxes are a factor in all of this rebalancing talk too, aren't they?
I'm glad you brought it up because I was actually thinking about that before you said it, that we should discuss it because there's a big difference between when it comes to taxes, rebalancing, we'll call it IRA, 401k dollars versus non-retirement dollars. So in the industry, we have what's called qualified versus non-qualified. Qualified just means that's money that's retirement dollars that's being tax deferred, and non-qualified just means it's your regular money that's not retirement dollars. And these monies are being taxed on a regular basis. So when it comes to rebalancing, and it's important that we have to understand that if we are selling positions, you could be getting hit with taxes. Let's just say whether it be capital gains taxes, things of that nature. And depending upon how long those positions were held, some of these taxes may be short-term gains versus long-term gains, which, short-term gains are taxed 20 to 30% higher than long-term gains. So there's, some of these mutual funds that people have. Sometimes, we'll review the particular mutual funds that clients have when they come visit us for the first time. And some of these funds, may have a what we call high turnover ratio, where they're doing a lot of buying and selling within 1 year. Let's say they have a 70% turnover ratio. Turnover ratio just means the amount of buying and selling that's going on within 1 year. So let's say there's 100 stocks in that portfolio, and the manager sells 70 and buys a new 70 within 1 year. That's a 70% a turnover ratio. Buys 50, buys a new 50, 50% turnover ratio. So the amount of buying and selling. So when these things are happening, and these managers are out there chasing return, not only that sometimes or you're within your portfolio, some of your returns can get eaten up by taxes. So there's a very strategic way that when we're rebalancing, we have to look at, again, I'm going to use the term non-qualified dollars. We'll talk about non-retirement accounts very differently than retirement dollars, 401ks, IRAs, things of that nature. Because while I'm doing the trading within the IRAs and 401ks, it's not causing any kind of tax consequence for the client at all. I can buy and sell and trade. There's no issues with short-term gains versus long-term gains or all the rest of it, because that money's all growing tax deferred. And later on, when you pull it out, you just pay the taxes based on marginal rates. But now when we're dealing with regular money, that is where we need to be very cognizant on how we go about doing the rebalancing. And you're right, Mark, towards the end of the year, there may be scenarios where we can take advantage of tax cost harvesting strategies, or even, let's say it's not even the end of the year. Let me give you a perfect example. Let's say a client calls me up and says, "Hey, Rick, you know what? I want to take a cruise. It's going to cost me, 20 grand." Well, now they say, and let's say I need to sell some positions in order to send them 20 grand. Well, because I know how we set up that portfolio, we can actually, the IRS, one advantage they have is they allow us to use specific identity method, which is basically I can go in there and sell the highest shares out first in order to raise the funds for that client for that cruise that they want to take in order to mitigate taxes. Or maybe they have a portion of the assets that are up 5%, another portion of the assets are down 5%. So maybe I sell, half the amount of the ones that are up 5, the other half that are down that 5. And now those two offset each other. I got them their 20 grand, they pay no taxes. So there are specific strategies that we do use for our clients that, depending upon what their circumstances are, that when we're investing, when we're rebalancing, we are making sure that everything that they are doing is tax managed. So very important that is treated that way, because again, non-qualified versus qualified dollars are going to be treated very differently.
There's a reason Fortune 500 companies have a chief financial officer, because there's a lot of moving parts in all this. Just listening to Rick right there, can you handle all of that, those decisions on your own? Maybe you can. And if you can, congratulations. I certainly couldn't. This is where Rick and the team at Safeguard kind of can be your own chief financial officer if it works out. A good fit for you, a good fit for them. 800-700-1980 to learn more. No cost. 800-700-1980. And I think, final 3 minutes, Rick, I think a lot of people think of diversification within their portfolio, right? As you were talking about mutual funds, a lot of times you think, I got 20 mutual funds, I'm really diversified. Well, 15 of the 20 are the same stuff, so you're not diversified. Taxes, though, you got taxable, tax deferred, and tax-free. I don't know if we think about being diversified in that category that you were kind of talking about.
You're diversified in what you mean, tax freeze? Is that what you're saying?
No, I'm saying being diversified in taxable, tax deferred, and tax free, having all three of those tax buckets kind of similar, maybe.
Oh yeah, absolutely. So yeah, of course. Again, this is where it's so important that the radio listener listening to the show right now, that it can't hurt for them to come in, sit down, give us 15 minutes, give us 45 minutes, and we can let them know, hey, a lot of the people listening to radio show out there are probably thinking to themselves, hey, listen, I don't know what I don't know. And it can't hurt to come in and, based upon your particular scenario, based upon what you're trying to accomplish moving forward, we may be able to share ideas with you that we've been using with our own clients for decades now that can enhance your situation. And quite frankly, Mark, you said something earlier, some people are like, hey, you know what, they can't keep up with this stuff, or they don't know how to do these things. There's some clients that actually know how to do these things, but they're like, I don't want to do these things. I don't want to have to manage my portfolio. Now that I'm retiring, I don't want to have to keep up with the tax laws. What I want is somebody to do these things for me. And of course, keep me abreast. I just want a team member, and they can just, every quarter or every month, let me know, hey, here's what's going on. Here's the situation. This is what we're doing, and keep me abreast of all the new stuff. So that way they don't have to do it. And it takes the pressure off of them, so they can enjoy their retirement and focus on the things that they enjoy, or focus on the things that are most important to them. So I think if they would like to take advantage of that, please give us a call. 45 minutes. It costs you nothing. Leave your checkbooks and all that behind. You can request me directly. And like I said before in past shows, if you give me 45 minutes, I can guarantee you that I'll at least give you 2 ideas that will enhance whatever it is you're doing. I've been doing this over 2 decades. I've seen so many scenarios, and I just need that time. Just give us a call, toll free, 800-700-1980, and we can set that up, and it's real easy.
Firm offers insurance services. Safeguard Investment Advisory Group, LLC is a registered investment advisory firm. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Safeguard Investment Advisory Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Safeguard Investment Advisory Group, LLC.